Hello all, in this video we are going to discuss accounting for lease from the perspective of lessee. So put yourself into the shoes of a lessee so that uh, you can be in a better position to understand the concepts. So the commencement of the lease, the lessee should recognize a lease liability and a right of use asset. So what is a lease liability basically? Let's say that you are a lessee and you are leasing an asset from the lessor. So the lessor has given you the right of using the asset for a period of time. And in return, as a lessee, you are supposed to pay some consideration in the form of money to the lessor. So this creates an obligation to you. So any obligation creates liability, and this liability is known as a lease liability. Right of use asset. This is quite straightforward. The lessor is not providing you the ownership of the asset. The lessor is providing you the right to use the asset for a period of time, and this creates an asset to you, and that asset is known as right of use asset. And this lease liability will be shown on the liability side of the balance sheet, and you have to show this right of use asset on the asset side of the balance sheet. Here we are going to discuss how to measure the lease liability. So lease liability is initially measured at the present value of lease payments that have not yet been paid. So to put it simple, lease liability is equal to present value of future lease payments. And this lease payment includes the following, that is fixed payments over the lease term. Let's say that you have agreed with the lessor to pay let's say 5,000 at the end of every month for the next 5 years, or 5,000 at the beginning of every month for next 5 years. So this is a fixed payment that you are supposed to pay to the lessor, and amounts expected to be payable under residual value guarantees. Um, you are the lessee, and as a lessee, you're providing an assurance or a guarantee to the lessor that at the end of the lease term, the value of the asset will not be lower than, let's say, 15,000. The value of the asset will not be lower than, say, 20,000. So you are providing an assurance or a guarantee to the lessor that the asset will have some value at the end of the lease term. So if you are providing such a guarantee or an assurance to the lessor, and that amount should also be a part of this lease payments. And options to purchase the asset that are reasonably certain to be exercised. Let's say that you have leased an asset from the lessor, and in the lease contract, the lessor is providing you an option to purchase the asset at the end of the lease term. He's telling you that, see, if you want, you can purchase the asset after at the end of the lease term, and you are also certain that, yes, I will exercise this option. As a lessee, I'm going to purchase the asset from the lessor. So in that case, the exercise price should be a part of this lease payment. This exercise price is nothing but the price that you have to pay to the lessor to purchase the asset. And termination penalties. So let's say that you have leased an asset from the lessor for 5 years, but at the end of the third year, you're going to the lessor and telling him that, hey, look, I don't need this asset anymore. Let's cancel the lease contract. In that case, the lessor will tell you that, see, we have put the contract for 5 years, but at the end of the third year, you're coming and telling to me that to cancel the contract. So you need to pay me some termination penalties. The discount rate. So basically here we have told that the lease liability is equal to present value of future lease payments. So to calculate the present value, we need some discount rate to discount the cash flows. So what is the discount rate that we are supposed to use to discount the cash flows? The discount rate should be the implicit rate in the lease. That is, this implicit rate is known as the target rate of return of the lessor. So you don't need to break your head over this, like how this implicit rate is calculated. It will be given in the question itself. So you don't need to break your head over this. If this implicit rate cannot be determined, like in the lease contract, if the implicit rate is not there, in that case, the entity should use its incremental borrowing rate. So what is this incremental borrowing rate? So let's say that you're not leasing the asset. See, you need the asset, but you're not leasing it. Then what will you do? You need to purchase it. So for purchasing the asset, you need money. So for money, you will go to the market and you will borrow from someone, and the rate at which you borrow, that is, someone is lending you the money, right? The rate, the interest rate charged by that person is known as the incremental borrowing rate. And this incremental borrowing rate should be used only when you can't uh, determine the implicit rate. If implicit rate is there in the question, you can use it. But if implicit rate is not given, then you should go for incremental borrowing rate. So let's look at an illustration on how to initially recognize a lease liability. Sadio leases a machine over 5-year lease term from BH from 1st December 2015. So here Sadio is the lessee and BH is the lessor. So rental payments of 75,000 are made in advance on 1st December each year, and the first installment has just been paid. So in this case, the fixed payment component is 75,000. So here we have, right, the fixed payments over the lease term, and this fixed payment over the lease term is 75,000 in this question, because here you have agreed to pay 75,000 on 1st of December each year for the next 5 years, because the lease term is 5 years. So on 1st December 2015, 16, 17, 18, 19, you have to pay 75,000. And the first installment has just been paid. So the useful life of the asset is for 7 years. And you ignore this for now. A lease arrangement fee of $1,500 was incurred by Sadio. You just ignore it for now. This is not useful in this question, but we will use it later. We will use it while calculating right of use asset. For now, you just ignore it. That's why I put them in the red color. The rate implicit on the lease cannot be readily determined. So here you cannot determine the implicit rate, but the incremental rate of borrowing for Sadio is 8%. So if Sadio had not leased the asset, then Sadio would have borrowed the money from the market to purchase the asset, and the rate at which Sadio would have borrowed the money is 8%. So that is the incremental borrowing rate, 8%. So here you need to use this 8% for discounting the cash flows, because the implicit rate is not given. So we are going with the incremental borrowing rate. And ownership of the asset is retained by the lessor at the end of the lease term. So the lessor is not giving any option to the lessee to purchase the asset. So at the end of the lease term, that is at the end of the 5th year, the lessee will give back the asset to the lessor itself. So the lessor is going to be the owner of the asset. So calculate the amount of lease liability. So I have provided you the solution here. See, the term of the lease is 5 years. That is, it starts from 1st December 2015 and it ends on December 1, 2019. So the term of the lease is for 5 years. And the first payment of 75,000 was made on 1st December 2015, because here they have given that rental payments of 75,000 are made in advance on 1st December each year, and the first installment has just been paid. So now you are in 1st December 2015 and you have paid 75,000 in advance. So this 75,000 will not be used in calculating the lease liability, because see here the lease liability definition says that present value of future lease payments, but this 75,000 is not a future payment. It has already been paid. So this ignore the 75,000 for the calculation of lease liability, and the subsequent payments are as follows. See, the first payment is made on 1st December 2015. So the second payment is on December 1, 2016, December 1, 2017, 18, 19, and amount is 75,000. So here in the question they have provided clearly, they have told that 75,000 are made in advance on December 1 each year. So on the 1st December of each year, we are paying 75,000. And we need to calculate the present value of this, because this first December 2016 payment is made after it is going to be made after 1 year. So what is the value of this 75,000 today? That is 69,444. So you need to calculate the present value for all the cash flows and sum them, add them all. You get 248,409.5, and this is the amount of lease liability, and this 248,409 will be shown in the liability side of your balance sheet.